AYGlobal brings you to the heart of a rapidly unfolding economic crisis. On April 20th, 2025, a sweeping 145% tariff on Chinese imports brought U.S. ports to a standstill. Nearly $14 billion worth of cargo disappeared, leaving docks deserted and store shelves increasingly sparse. At the Port of Los Angeles, the scene is eerily quiet. Retailers are scrambling to manage dwindling stockpiles as anxiety builds behind the scenes. What the nation faces is more than just shipping delays. It's a looming supply chain collapse. Let's break down the core developments of this economic confrontation and what it could mean for ordinary Americans. Waterfront in crisis. Port disruption escalates. The Port of Los Angeles, America's gateway to the Pacific, is bearing the brunt of the impact. Executive Director Gene Soroka reports that cargo traffic could drop a staggering 35% year over year. This isn't a slowdown, it's a freeze. Major carriers like Maersk and Hapag-Lloyd are scaling back, canceling routes or steering ships elsewhere. Over 80 scheduled West Coast arrivals were canceled in April, and May looks just as grim. Back in China, export terminals are overwhelmed with containers stacking up like forgotten carts. Some vessels are bypassing the U.S. completely, while others wait aimlessly for instructions. Unlike the pandemic-era delays tied to safety restrictions, this is a deliberate, policy-driven halt, affecting everyone from crane operators to customs and trucking companies. Dock crews are seeing their hours slashed, cranes remain still, and even Gulf and East Coast ports, though more diversified, are feeling the drag. The Northwest Seaport Alliance has warned of up to 30% drops in incoming freight, with exporters now recalling shipments from canceled deals. With half of LA's port activity historically linked to China, this is more than a ripple. It's a shockwave that's already echoing in retail aisles. Retailers under pressure. Inventory running low. Across the U.S., retailers are being squeezed by these tariffs. Giants like Walmart and Target, reliant on Chinese supply chains, are navigating severe disruptions. The National Retail Federation forecasts a 20% decline in import cargo for the second half of 2025. With shipments at a standstill, inventories are depleting fast. Gene Soroka says most large retailers have just 5 to 7 weeks of stock remaining. Shoppers may not see completely bare shelves yet, but expect fewer choices and rising prices. For smaller businesses, the stakes are even higher. Jay Foreman, CEO of Basic Fun, warns that missing holiday deliveries can turn valuable goods into financial losses. Inventory planning is now a risky game. Finding alternative suppliers mid-season is not only costly, but logistically daunting. Big box stores may weather the storm, but small retailers are stuck between shrinking profit margins and escalating expenses. Shoppers are already seeing fewer options in categories like apparel, home goods, and electronics. While prices have stayed mostly steady for now, inflationary pressure is building. If this impasse drags on, price hikes are almost certain. Enjoying this breakdown? Subscribe to AYGlobal for updates on vehicle trends, trade policy drama, and supply chain shifts. Now, back to the big picture. Economy hits the brakes. National slowdown. The $14 billion hole left by missing cargo and tariff tensions is now dragging on the broader U.S. economy. The first quarter of 2025 saw a 0.3% GDP dip, the first decline since 2020. The transportation sector is feeling the squeeze hardest. With West Coast ports stalling, freight via trucks and rail is declining. Logistics companies are slashing hours, parking vehicles, and even furloughing workers. Without a recovery in container flow, layoffs could spread to warehouses and distribution centers. Manufacturers, especially in the auto industry, are now paying more for components like electronics and interior parts. These added costs are starting to trickle down to consumers, further pushing up durable goods inflation. The uncertainty around how long these tariffs will last is stalling business decisions. Companies are pausing expansions, holding off on hiring, and cutting back on capital investment. Post-pandemic recovery confidence is slipping, caught between inflation, halted investment, and constricted trade routes. Even if the tariffs were lifted immediately, it would take months for the economy to regain traction. Right now, the U.S. economic engine is sputtering, with no quick repair in sight. Rethinking global supply chains. Can China be replaced? With imports from China effectively frozen, American businesses are scrambling to diversify their sourcing. Countries like Vietnam, Thailand, and Indonesia are top contenders, but matching China's scale is proving nearly impossible. Vietnam's facilities are maxed out, ports are congested, and labor resources are stretched. Thailand is struggling with quality issues amid soaring demand. These countries can't yet match the efficiency and capacity China has refined over decades. Supply chain overhauls aren't quick or cheap. From vetting new suppliers to setting up logistics, the process can take 1 to 2 years. In the meantime, companies face bottlenecks, customs slowdowns, and rising freight costs due to limited cargo space. Some tech and auto firms are considering reshoring production to the U.S., but high labor costs and regulations are serious obstacles. While domestic manufacturing works for highly automated or high-margin products, it isn't viable across the board. For businesses using just-in-time logistics, even minor disruptions derail entire operations. While spreading out supply chains increases resilience, it sacrifices the speed and cost efficiency companies are used to. The pivot from China has begun, but it's a rough road ahead. Fog ahead, the uncertain road of global trade. The U.S.-China trade relationship remains at a standstill. Treasury Secretary Scott Bessent has called the tariffs unsustainable, yet there's no breakthrough in sight. China, for its part, has stayed quiet, likely betting on American political or business pressure to shift the balance. This deadlock has birthed a new term among economists: structural volatility. Retailers are stuck in limbo, and manufacturers are managing two separate strategies: one for ongoing tariffs and another in case they're lifted. Capital spending is down, and companies are diverting R&D budgets into stockpiles and risk mitigation. Consumers are already feeling the pinch: fewer product options, shorter seasonal releases, and slowly rising prices, especially in tech, apparel, and furniture. Labor markets are also under strain. Warehouse hours are reduced, hiring is frozen, and prolonged disruption may trigger layoffs. Meanwhile, America's global trading partners are watching closely. If the U.S. is seen as unreliable in trade policy, other nations may shift alliances toward the EU or Asia-Pacific blocs. This standoff could permanently reshape the global supply map, and if negotiations remain stalled, the U.S. might lose ground in the very trade systems it once dominated. Final thoughts. When trade policy meets reality, this $14 billion shipping freeze isn't just a logistics issue. It's a turning point. Ports, retailers, and manufacturers are all adjusting to a world where trade policy directly impacts operations. From idle cranes to bare shelves and corporate hesitation, the system is grinding through a massive transition. How companies and policymakers respond now will shape the next era of commerce. So now we ask you, should the U.S. stick with the tariffs or head back to the negotiating table? Can Southeast Asia realistically step in for China? Is reshoring a viable solution or just a political talking point? Drop your thoughts in the comments. We want to hear from gearheads, strategists, and everyday thinkers alike. Thanks for tuning in to AYGlobal. Stay with us for more deep dives on trade, industry, and the shifting landscape ahead. And don't forget to check out the other videos on your screen. There's plenty more to explore.